Government Relations. Welcome everyone to today's NAEA Government Relations Update. Please note that this webinar is being recorded. My name is Jessica Masters and I'll be the technology webinar moderator behind the scenes. We have an exciting webinar today with Michelle McCaughey and Thad Ing. And with that, Michelle, the floor is yours.
Thank you. Thanks, Jess. I just wanted to welcome everyone. Glad you're here. It looks like we have more than 102 people on the line already, which is absolutely outstanding. Thank you so much. I just want to remind you to please put your questions in the Q&A box and not in the chat box. And we'll get to them as they come along. And Thad has an awful lot to unpack today, so I'm not going to waste any more time and kick it off to you, Thad.
Great. Thanks, Michelle. Yeah, my goal is to try to cover everything in about 40 minutes, but please ask questions throughout, put them in the Q&A, and we'll try to answer them just to keep it a little more interesting here. And then we'll leave some time at the end for Q&A, or at least that's the goal. But lots going on, as all of you know, in the tax world here in DC. And so excited to dive into some of that. So we'll be walking through some of the expiring tax provisions, the reconciliation process that Congress is going through right now, with the House passing their bill 2 weeks ago, looking at what's in that bill, and then what the process looks like in the Senate. We normally try to, give an update on everything happening here in Washington, but since this is the prime topic and one we really care about, we're just going to focus on the bill and kind of the process around that bill today. Michelle, thanks for being here. Sam also was instrumental in helping put this deck together, so thanks to Sam.
Hey, Thad, before you begin, we've had a question about the handouts. Is the deck going to be available?
We can make that available. I know we sent it to Jessica. Yeah. So if you guys want to, put up a link or something that works for us, or share it in the chat.
Great, thank you.
So we've talked about this, since the elections, but obviously we're in Trump 2.0, which looks a little different than Trump 1.0 back in 2017, and one aspect that is part of this is the very narrow margin of majority that Republicans have in both the House and the Senate. You've got a razor thin 3 seats, and I believe it's around 3 seats in the House, and then 53 to 47 in the Senate, which creates sort of some of the opportunities and challenges for passing legislation that we'll be talking about today. So I know we've talked about this in the past, but it's worth reiterating that the first 2 years of any president is really when the bulk of the legislation gets passed. Going back, a long way back, but just more recently, George W. Bush, whether it's No Child Left Behind, the 2001 tax cuts, the Patriot Act, a range of other things, all happened in those first 2 years. With President Obama, we had the stimulus package, which I believe was the first 100 days. While we say first year, first 2 years, really the first 100 days is sometimes where momentum around these things get started. Affordable Care Act was in that first year. Dodd-Frank, the 2010 tax deal kind of came towards the end of the 2 years. And then, of course, in Trump's first term, the Tax Cuts and Jobs Act passed, and what they used reconciliation for that, which we'll be talking more about today, and a number of other pieces of legislation. And then with President Biden coming out of COVID, there were some large packages: the American Rescue Plan, the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, the Chimps and Science Act. All these things happened in the first 2 years. And I emphasize that because there's a window for new presidents to really get legislation done. One, it's momentum from the election. to its goodwill. It's also very common to lose Congress after those first 2 years. We saw it with most of these presidents, where they at least lost one chamber of Congress, and so this is kind of the opportunity that President Trump is trying to seize on right now, to move legislation as quickly as possible, get his agenda into place, especially since this will be, he will not be having a second term after this, or a third term, I should say. So tax reform and reconciliation, sort of why are we here? And so you guys know as well as anyone while we're here, why we are here, because of the expiring tax provisions from the 2017 law. We saw rates come down significantly, and a number of other changes in the Tax Cuts and Jobs Act in 2017. But because of the costs and other factors, most of those provisions are expiring at the end of this year. And so come 2026, January 1, everyone's marginal tax rates would go up. The increased standard deduction would go down. Personal exemptions would come back. Child tax credit would go back to where it was. The 199A pass-through deduction, the 20% deduction would go away. The employer credit for paid family and medical leave would go away. All of the changes that we saw around charitable contributions, around SALT, putting the 10% cap, the changes in the mortgage interest deduction, capping that, the overall limitation on itemized deductions. These are all things that are expiring at the end of this year if nothing is done, which is why there's this big momentum and this idea that something has to get passed this year. There's really no choice. And so that's kind of why they call this the Super Bowl of tax, the year of tax. This is why, because of the rates going up January 1, 2026. Now, of course, there were provisions in the 2017 law that were permanent. A lot of those were on the business side. So corporate taxes, for example, were made permanent. A lot of the other business provisions. There were also some business deductions that were phased out to help pay for that bill, which are in the mix this time. We'll talk more about those, things like R&D. But these expiring tax provisions are kind of what set the stage. We'll talk a little bit more about new stuff in the mix as well, those Trump campaign promises, which are at the bottom of the slide. So the reconciliation process, we've talked about that a lot. Just 101 for folks that forget what it is. Basically, normally to pass legislation, you need a majority in the House. So a simple majority can pass a bill. But in the Senate, because of the filibuster and some of the rules, you really need 60 votes to pass most legislation. I mentioned that Republicans have a 53 to 47 majority. So if you were to pass a bill under regular order, you would need those 60 votes. But there's this process called reconciliation, which was really developed to try to help reduce spending. And it says if you follow this process, which has lots of rules, that you can pass something out of the Senate with a simple majority. And so this has been used more frequently in recent years, everything from passing ACA to trying to repeal ACA to the TCJA to some of those Biden bills, Inflation Reduction Act. Those were all passed along party lines, simple majority in the Senate, using reconciliation. And we don't have to go into a ton of detail on all of these steps, but I'll kind of walk through them. So the first thing that you have to do is pass a budget resolution that includes reconciliation directives to individual committees. We'll get into the resolution that passed this time around. It had different rules for the Senate and House, which was a bit unusual. But then each committee kind of takes those rules, these specific committees, they come up with legislation responding to kind of the parameters in the resolution. And then they mark up that legislation, or at least that's how they did it in the House. It might look a little different in the Senate. And then they report those out of committee, and then it all goes to the Budget Committee. We're now on 2B. The Budget Committee packages those bills together. It ends up going, this is not on the slide, but it ends up going to the Rules Committee, and then eventually on the House floor. And then the Senate does a similar process. The differences have to be resolved between the two bills, and eventually the reconciliation bill can be enacted into law or vetoed. We are in the House. We are sort of between 3 and 4 because they have passed this out of the House. In the Senate, we're still around 2A, which they might actually skip and go straight to 3. And so we're in the middle of this process right now of using reconciliation to pass a tax package. So I mentioned the budget resolutions. There was a lot of disagreements between the House and the Senate and within the Republican Party on how they should move forward on this tax legislation. They needed to agree and both pass the same budget resolution, though. And so the way they ended up doing it was saying, well, we'll put a little different rules for the Senate and for the House. You know, at the end of the day, you have to pass the exact same piece of legislation through both chambers. But this punted some of those hard decisions. And so you look at the maximum gross deficit increase, it was 4 trillion in the House, it was 5.8 trillion in the Senate, using something called current policy baseline, which basically allows them to extend existing tax cuts. There's the minimum, this is the number that really stood out to people, the minimum gross deficit reduction. The House called for $2 trillion in spending cuts. The Senate just called for 4 billion in cuts because they said they needed flexibility around the rules. Net deficit impact 2.8 trillion versus 5.8 trillion, but that number is a little, it takes into consideration the current policy baseline. And then implied baseline, so traditional law. So I'll try not to get too into this, you know, policy baseline, but I'll just say very simply so folks understand why it's in here. Normally, if you extend a tax cut that's expiring, then you have to, then that scores as a cost. So if a tax cut is expiring at the end of this year and you want to extend it for next year, then you have to, the budget, CBO and JCT and Congress score that as costing money because you're extending it. What the Senate wants to do is say, well, if it's current law, if you've currently got that tax break and you just extend it, it shouldn't really cost anything because you're not you know, actually cutting taxes, you're just extending your current tax rate. And so that's a whole debate. And the Senate is leaning towards saying if they extend tax cuts, it won't actually cost anything in terms of how they score it. Now, it doesn't impact the budget debt and deficit at the end. But that's where, you know, some of these ideas get a little complicated, but it's basically how is Congress scoring these things and saying how much these tax cuts are actually going to cost.
Dad,
Yep.
there's a question. Isn't there a step in between 4 and 5 where both chambers must vote on the reconciled bill or the House must accept the Senate passed bill?
Yep. So yes, each chamber has to pass the same bill for it to become law. So if you go to conference committee, you would reconcile the two bills and come up with one bill, and then both those bills would have to pass the House and the Senate. So it doesn't go into that detail, but I guess it kind of is meant to imply it. But yeah, that's accurate.
Thanks.
So May 22nd, which was, I think now about 2 weeks ago, the House passed what they formally titled the One Big Beautiful Bill Act. This was a very tight vote. It passed 215 to 214. 2 Republicans voted against it. Funny enough, one other Republican slept through it. He had snuck off to some back office to take a nap. His alarm didn't go off and he slept through it. And so he emerged and said, I would have voted for it, but they ended up not needing his vote. And so the One Big Beautiful Bill Act passed the House. We'll talk a little bit about what's in there. Mike Johnson, Speaker Johnson, muscled that through. It looked like, it was in a die multiple times, or he didn't have the votes for whether it was the state and local tax, the SALT deduction cap was very controversial. Some of the spending levels and the Medicaid cuts, but they were able to get everyone in line and pass that with President Trump's help. Jason Smith, the chairman of the Ways and Means Committee, was very involved in kind of putting this package together, the different pieces of it, and negotiating with the various stakeholders to try to get something that they could pass through that also included the president's priorities. As I mentioned, the House Freedom Caucus, which is the conservatives, the SALT Caucus, which is the more New Jersey, New York, California folks that come from high tax states, they were really putting up a fight till the very end and holding out. And so some compromises had to be made for both of those factions. So what's in there? It would permanently extend, beginning in 2026, the TCJA marginal tax rates for individuals. It would permanently extend the enhanced standard deduction, which would be annually adjusted for inflation. And additionally, the measure would temporarily increase for tax years 25 through 28, the standard deduction by an additional $1,000 for individual filers and $2,000 for joint filers. So that would go up for a few years. The Paid Family and Medical Leave Act credit for employers would be made permanent. It allows employers to claim non-refundable credits ranging from 12.5% to 25% of the wages paid to workers on paid leave. And the mortgage deduction, it would make permanent the TCJA change limiting the mortgage interest deduction to the first $750,000 of the home mortgage deduction. So all those things, if nothing passes, if nothing gets through the full Congress, all these things will expire, but this bill makes those things permanent. So some of the other provisions, child tax credit, that enhanced credit is increased through, it says permanence at the top, but it says increased through tax years 2025 through 28. Let me move, there we go. So it's an additional $500. Sorry, my text was being blocked there. So for the child tax credit, it's made permanent, but it's an additional $500 for those 3 years. So similar to the standard deduction, sort of an additional increase. The measure also makes the additional child tax credit permanent. So the increase we got, as well as the income thresholds, permanent from $200,000 for single filers and $400,000 for joint filers. The alternative minimum tax would permanently extend the modification of the tax made in TCJA, which would increase the exemption amount that reduces the income subject to the special AMT rules and raise the income thresholds at which the exemption starts to phase out. I know that's something all of you guys deal with in your practices. The estate and gift tax. It would permanently extend and increase the exemption for the estate and gift tax to 15 million for individuals, 30 million for married couples. I believe that's adjusted for inflation too. This has come up in recent days because I know Majority Leader Thune would like to have no estate and gift tax. But he sort of acknowledged that that's highly unlikely because of the cost, and that this will probably stand in the Senate bill. And then the pass-through business income 199 cap A, the measure would permanently extend and increase the deduction. So it was 20% deduction before, now it goes up to 23% beginning in tax year 2026. And again, that would be permanent.
Thad, before you move on to the
Yep.
salt tax, we have a couple of questions. One is there a higher standard deduction for seniors?
So there is a social, and this should come later in the deck, but President Trump talked about no taxes on Social Security during the campaign. And you cannot technically mess with Social Security in any way under reconciliation under the Byrd rules. And so instead of actually eliminating tax on Social Security, they gave an extra $4,000 deduction for seniors. And that's, I think, separate or on top of, any standard deduction. And so that might be what they're referring to in the question.
And one more question. Will the child tax credit thresholds be indexed for inflation?
Good question. I'd have to double check. We can double check that.
Thanks.
Go to my next slide here. There we go. So SALT deduction. As folks are well aware, TCJA capped the SALT deduction at $10,000. And this has been a big issue for high income areas. Think, Connecticut, Westchester, New York, parts of New Jersey, suburbs of New York City, suburbs of Chicago, California. Folks are feeling upper to middle class, families and individuals were feeling like they were getting killed by this SALT cap. And the elected officials, the congressmen in those areas, this became kind of their number one issue, and said, we've got to fix this. A lot of other areas of the country were incredibly unsympathetic because they said, hey, you choose to live in these places with high state taxes, high local taxes. These are wealthy areas. They didn't have a lot of sympathy for these complaints. But the reality from a leverage standpoint is this cap was expiring. So if Congress does nothing, the cap goes away and folks could write off all of their state and local taxes. But this was a major pay for TCJA and was going to have to be a major pay for any future bill. And so this was kind of one of those issues that they were negotiating till the very end. And they came up with increasing it to $40,000 for households with under $500,000. And then in 2026, it goes up to $40,400 for households with income under $505,000. And then it's increased 1% each year through year 2033, and then remains at that amount. For income that exceeds the thresholds, the deduction would phase out by 30% until it reaches $10,000. So it's got these salary caps on it. And the bottom section, and this got a lot of attention in the CPA world. I don't think it hit EAs as directly, just because folks there are probably fewer partnerships. But the measure would define the taxes subject to SALT cap and modify the accounting methods by which pass-through businesses such as partnerships and S corporations would use to claim the deduction. SALT was a major issue. They came to terms in the House, but we're going to hear more about it in the Senate because they're already saying a lot of senators or there a lot of Republican senators, because if you think about where Republican senators come from, it's not New York, California, Connecticut, Illinois. And so they're not as sympathetic to this. But you've got the SALT caucus in the House saying if the Senate sends us back a bill that waters this down, we might not vote for it. So this is an issue that is not going away yet. We'll continue to watch it closely. So new tax deductions. During the campaign, as we all know, President Trump called for a lot of different deductions. He went to Las Vegas and called and said you shouldn't have to pay taxes on tips. He said you shouldn't have to pay taxes on overtime. He said you shouldn't have to pay taxes on Social Security. And so the tip deduction, that did make it in the House bill. It would create a deduction for qualified tips for tax years 2025 through 2028. So this is not permanent. Only employees with earned income under $160,000 and who work in a work-eligible Social Security, have a work-eligible Social Security number and are eligible for the deduction. And so they kind of define that as occupations where tipping is customary, paid voluntarily, and determined by the payer. And so they don't want, EAs to all of a sudden say, well, my client gave us a tip. They want it to be, waiters, waitresses, bartenders, folks that customarily have received tips. Overtime deduction. Alabama did something like this and actually just repealed it because apparently it cost a lot more money than they expected and was very hard to implement. But this would establish a deduction for overtime compensation for tax years 25 through 28, structured similarly to the tip deduction, but overtime pay would exclude qualified tips. Qualified overtime compensation is defined as overtime compensation paid to an individual required under the Fair Labor Standards Act. And so that's an important qualification because a lot of people said, well, how are you going to define overtime? They went with the FLSA definition. Some states, you look at California, they have a higher floor in terms of the definition of overtime. A lot of companies use a different definition, like they might not count your vacation or your sick time towards overtime, count it against you essentially, where FLSA looks at it a little differently. And so from an implementation standpoint, if folks have small business clients, that will be something they'll have to think about. Enhanced deductions for seniors. I think this is probably what your question was getting at, Michelle. The measure would establish a deduction for overtime compensation for tax years 25 through 28, structured similarly to the tip deduction. That might be the wrong language in there. But essentially, there's an enhanced deduction for seniors. We'll get that fixed. We'll get the correct language in there. But I believe it's a $4,000 deduction that seniors will be able to take. And then auto loan interest deduction. So the measure would create a deduction up to $10,000 for interest payments on auto loans for tax years 25 through 28. The deduction can only be claimed if the vehicle assembly was finished in the US. So this is one of those that I think people were skeptical that this would get in the final bill, but they were able to get it in there.
Before you move on to the business provisions, I missed a SALT question. And that is, does the 10,000 SALT cap mean that MFS won't be penalized with the $5,000 limit?
I don't know if I want to answer that. Why don't we hold that one and we can try to get an answer.
Okay. And then is the auto loan interest deduction an itemized deduction?
So, good question. I don't think it is. For most of these, even I know for the tip and the overtime, and I think all of these, even if you take the standard deduction, you were able to get this deduction kind of on top of that. But we'll confirm that that's the case for all of them. But I think they wanted people that took the standard deduction to be able to still get these.
Let's see, there's one more. How are we supposed to know where the final assembly was?
Yeah, good question. So for all of these, they will have to put out guidance and regulations, and FAQs, Treasury and IRS. And so these are the kind of things where all the details aren't exactly figured out. And I think that would be part of, there would be some kind of like the EV credits. There would be some kind of list that is published about who qualifies and who doesn't, what cars qualify. And so I would imagine a similar process. I'll also note that these say 2025 through 2028. Well, that's January 1, 2025. We're in, July right now. So that's a retroactive, or June. It'll be at least July before something passes. And so that's a retroactive, action. And you look at some things like the overtime definitions. Well, or is everyone tracking or have the ability to go back and track overtime based on that definition? And do payroll companies have the ability to pull that data if it hadn't been tracked that way since January? I think prospectively, folks can make changes and collect that data. But that's part of the discussion right now too. Is are they making this unnecessarily complicated by making it start retroactively January 1, 2025? Of course, everyone that's going to get one of these credits would like to get one this coming April and not have to wait. But it does create some challenges from an implementation standpoint. All right, business provisions. So these are provisions that they actually, as a pay for TCJA, they said we're going to phase out some of these really generous business provisions since we're lowering the corporate rate, since we're lowering marginal rate, since we're going to do the 20%, 199 cap A deduction. We're gonna take away some of these other things. But we'll wait a little while. We won't start phasing them out, for 5 more years. Well, of course, when they started to phase them out a couple of years ago, everyone said, wait a second, you can't phase out research and development. That's going to cost us jobs. That's going to, cost us innovation, business interest expense, depreciation deductions. And so there was a big movement to say, this is horrible. This is a jobs killer. We can't phase these things out. You might remember last year, there was a bipartisan bill between Senator Wyden and Jason Smith, that addressed a lot of these, that said, we're going to retroactively, put these back in place. So for R&D, you'll be able to immediately deduct the cost. You won't have to do it over 5 years. Similar for business interest expense to go back to how it was before 2017, and depreciation deductions. So they were not able to get that bill passed for a variety of reasons. These provisions did fully go into effect. And And so now they're looking to not retroactively fix them. So if you had to pay, more in taxes in 2024 because of the R&D, not being able to immediately expense things, you're kind of out of luck. But they are saying, all right, prospectively, we're starting January 1, 2025. So a little retroactively, we're gonna fix that. And so, it's immediate expensing for R&D instead of having to take that over 5 years. For business interest expense, it would allow businesses to calculate their adjusted taxable income without including deductions for depreciation and amortization for tax years 25 through 29. For depreciation deductions, the measure would restore 100% bonus depreciation for certain property placed in service from 2025 to 29. It would also allow taxpayers to immediately deduct 100% of the cost of qualified production property that's placed in service before 2033 and is an integral part of a production activity. These, as you'll notice, are not permanent. When we talk about the Senate bill, or what the Senate's looking at in a few minutes, this is something that some senators are saying, let's not go through this again. Let's make this permanent. Of course, when you make something permanent, it costs more money. And this actually came up at the White House yesterday, where senators were arguing to President Trump, we need to make these permanent. President Trump said, well, it costs more money. And if we have them short term, it'll incentivize people to go spend these money because they're scared it's going to run out. And so he made sort of an economic stimulus argument. And then other provisions, opportunity zones, folks will remember those were created in TCJA. They've adapted the language a little bit to make the opportunity zones a little more targeted, to tighten up the definitions of who qualifies. Low income housing credit, and corporate charitable donations. They changed those to say that you could take you could write off the donation if it's between 1% and 10% of taxable income. So if a corporation makes the donation less than 1%, sort of in aggregate, for the year, they're not allowed to take the credit, and anything more than 10%, they're not allowed to write it off. It's between 1% and 10%. And by having that 1% in there, I guess it probably raised a little money and maybe also encouraged corporations to give away, at least 1% of their income. So repealing clean energy tax credits. This might be one of many of the reasons that Elon's come out strong the last couple of days against the bill. The measure would eliminate the maximum $7,500 tax credit for individuals to purchase certain new electric and hybrid vehicles, starting in 2026 for most vehicles. Some of these credits, they sped up from the Inflation Reduction Act. They were going to let them phase out over a few years. And in the last minute negotiations in the House, they sped up saying, all right, some of these clean energy credits, we are going to have them end more quickly because it'll raise more money. It'll make the conservatives more happy. But that's also caused, consternation, with some folks don't think they should take these away so quickly. We focus mainly on the tax rates, but this is a big bill. And so lots of healthcare provisions, technology, stuff around the environment, education, a lot of stuff around student loans, energy, immigration. So I'm not going to go through all of these, but obviously there's a lot in this bill beyond just the tax provisions. So, and we're at about 4:40. So I'll maybe talk for about 5 more minutes, and then we'll try to get into some Q&A. So the cost, JCT, which is the Joint Committee on Taxation, came out this week and said the House bill would cost 3.94 trillion. That's how much it would add to the deficit. Let me pull this down. And so, or I said that kind of hesitantly because there are some cuts in the bill. And so maybe it was closer to 3 trillion would add to the deficit, but basically it's an increase the deficit by trillions of dollars. And this is a big concern it was a big concern for some conservatives in the House, but this is kind of coming back up in the Senate. And we hear people like Senator Ron Johnson saying we need more cuts out of this bill. This is spending too much. We've seen Elon Musk obviously come out. And so this is some of the stuff they're grappling with as they try to get this over the finish line. So the bill passed out of the House. It's now over in the Senate. And all eyes are really on Majority Leader Thune as he's trying to, he's got 53 Republicans. He needs 50 to pass a bill out of the Senate. And he's got folks on all sides of every issue. Now the question is, will they really stand up and vote against the bill? And so when you look at the Senate process, Senator Crapo's chairman of the Senate Finance Committee, and a lot of, there's different committees that are implicated, but all of the tax stuff and all of the Medicaid stuff runs through the Senate Finance Committee. And so the text that this committee puts out, and they're working on it right now, it could be out as early as the end of next week, will be central to sort of how are they able to thread that needle. And they've got, because it's reconciliation, they've got some sort of complex rules that they have to follow that the House doesn't have to follow, but obviously the same bill has to pass both houses. So ultimately the final bill has to follow these. All provisions must have a budget impact. They cannot be pure policy. So it must either be a tax cut or a tax cut, tax increase, spending cut, but it's got to have a budget impact. It cannot increase the budget outside the 10-year window. The current policy baseline, that sort of weedy thing I mentioned, is one way they're trying to get around that. But it's also why you have sort of short expiration dates on some of these provisions, because if it's a brand new policy, like no tax on tips, you can't use the current policy baseline. It cannot make changes to Social Security, which is why they did the deduction for senior citizens. And a lot of these questions about does it violate the Byrd rule will be the arbiter will be Senate parliamentarian Elizabeth McDonough, who kind of makes the judgment call on whether something should be in or out. So I mentioned there's, a needle that has to be thread and folks on various sides of these issues. Senator Rand Paul from Kentucky in the top right, he has said he will not vote for a bill that increases the debt ceiling. The House bill increased the debt ceiling by $5 trillion, I believe it was. And so he said he will not vote for any bill that increases the debt ceiling. That's kind of a top priority of this bill, so they likely will not have Rand Paul's vote. Ron Johnson, just below him, has said he wants spending levels to go back to pre-pandemic levels. Spending has sort of increased significantly since COVID, and those negotiations are happening right now. But he's pretty strong that he wants significantly more cuts. So we'll see what happens there. Mike Lee from Utah, the upper left, has had similar concerns about spending. Josh Hawley from Missouri, in the bottom left there, has raised major concerns about cuts to Medicaid. And other senators have as well, saying he will not vote for a bill that cuts Medicaid by too much. So on one hand, you've got folks saying, don't cut stuff too much. On the other hand, other folks are saying we need much more cutting of spending. And so that's what the Senate's trying to navigate right now, along with going through the Byrd rule process. So next steps, Thune and the president have said they would like to get this bill through by July 4th. I've been a skeptic on all of these timelines, and the House sort of proved me wrong multiple times because they managed to, sort of force the legislation through. Trump kind of leaned on holdouts, and they did get the votes. And so we'll see if that carries over to the Senate. The Senate has its own tradition of independence, of not caving too easily to the president. So we'll see here if they can keep the coalition together. And then whatever comes out of the Senate, because it'll look different, at least a little bit different than what's in the House bill, then they have to reconcile with the House, come to something that can pass both houses. And that's going to be a challenge because, for instance, on SALT, if the Senate really waters that down and doesn't stick to the agreement that was in the House, then they could have a problem with when it goes back to the House. And so, there are two ways to pass legislation to the point of the earlier question. One is sort of a ping pong. So the Senate could amend the House bill, send it back to the House, and the House could just pass that. Or amend it, send it back, and you can go back and forth until until a bill passes both houses. Or you can have a conference committee where you kind of work out the differences between the two bills, come up with one bill, and pass that through both houses. And so we'll see how it's handled. I've heard they're leaning towards more of a conference committee approach, but that can also take time, and they're looking to do this quickly. So. And then one slide we added here at the end is just some of the chaos we've seen around this just in the last 24, 48 hours. Elon Musk came out and said his first tweet was, "The massive, outrageous pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it." He then called on members of Congress to kill the bill. And then I saw earlier today, he said, President Trump would not have won without my support. He is being ungrateful. So the gloves are off. How does this impact passage of the final bill? I don't think it's good for it. That doesn't mean that Elon Musk, is going to derail it. But, I think the big question is, do they muscle this thing through, largely looking like it does now, with the president leaning on folks, or do they not have the votes? Does it kind of blow up a little bit? And do they have to? They're not going to go back to square one, but they might have to strip some of this stuff. They might have to pare it down a little bit. We've seen that happen with past legislation. If you remember, Build Back Better, it was this big, massive bill. And Manchin and Sinema, that they were passing that with Democratic votes, and Senators Manchin and Sinema said it's too big, and so it kind of blew up. And then they came back a few months later and ended up with the Inflation Reduction Act, a smaller bill. And so, the question is, does something like that happen, or are they able to muscle this through? And I think we're all kind of waiting to see. No one really knows the end of the story yet. But any questions, Michelle, coming in?
Yeah, we've got a couple of questions and a comment. The comment is on Medicaid, and working 80 hours a week is a lot, way more than normal work. Any thoughts on that?
Is it 80 hours every 2 weeks?
I don't know.
Yeah. No, it's a good question. I mean, I assume it's not 80 hours a week. I would assume it's 40 hours a week, but I'm not exactly sure. I know they put some pretty tough work standards in there, but I think it's probably 40 hours a week.
Somebody has responded it's 80 per month.
per month. Okay. Okay.
And then,
That's
okay. And then there's one other question on the bill. Given Elon Musk's strong opposition, mainly over debt and removing EV credits, do you think his influence could sway any Senate votes?
I think it gives cover for folks that might not want to vote for the bill. You saw a few people, well, you saw some Democrats like Chuck Schumer tweet out, I agree with Elon Musk, I agree with Elon Musk. So obviously there's gonna be political fodder like that. But if you're a House Republican that was feeling the pressure from Trump, but really didn't want to vote for this, or if you're a Ron Johnson who's been, kind of out on his own saying this thing is way too much spending, it muddies the water enough, it muddies the debate enough to give a little more cover for folks that want to come out in opposition. If you have everybody breathing down your neck saying vote for this thing, from Trump to Elon Musk to everyone else, and if you don't vote for it, we'll spend money against you or primary you, all that, it's harder to vote, to vote against it. But now you've got Elon Musk saying the opposite. He's saying, if you vote for it, I'll go spend money against you. And so it kind of gives, a little bit of cover if you don't want to vote for it.
We've got two questions on other issues that we're working on outside of this bill.
Okay.
One is there any news on the TAS Act?
No. So generally, tax administration bills move separately from this type of bill, and they tend to be bipartisan and budget neutral. And so we have continued to talk to Crapo and Wyden staffs about the bill. I don't know if the person asking the question was at the fly-in, but they obviously were part of a panel at the fly-in, and so they're continuing to work on it behind the scenes. They had the comment period. They say they're still digesting the comments, which were due in March, and still working on it. But this is kind of that will be a post-reconciliation bill exercise, if that makes sense. So they're working on it, but it's not actually going to go anywhere until we're done with this other stuff.
And then one more question or thought on our favorite topic, which is any thoughts on Billy Long?
So he did make it out of committee yesterday, or 2 days ago, Tuesday.
Yeah.
If folks, did not see that. So one interesting little tidbit, apparently Senator Grassley was inclined to vote against him. And, Senator Grassley has been a champion of the IRS for a long time. With all these recent funding battles, that's gotten a little muddied, but traditionally Senator Grassley was someone that really cared about the IRS. And apparently he spoke to a number of senators and said he had real concerns, and would anyone, want to join him in opposing Billy Long? And he didn't have any takers. I think folks felt like, there's only so many battles you can have with President Trump, and this probably wasn't one they wanted to pick. And so he ended up saying, well, if I don't want to be the only one, so he voted to advance him, and so it'll go to the floor at some point, maybe later in June or later in July, we'll see. And I assume he'll get confirmed just because he did get out of the Senate Finance Committee along party lines. The hearing, there's lots of mixed feelings about him in terms of his qualifications, his expertise, his experience, with tax legislation or lack thereof, his work on some of these tax credits. And so most of it's out in the open now, because between Senator Wyden and Senator Warren, I mean, they kind of went after him on everything. I think some people were satisfied with his answer, some were not totally satisfied. But I think he'll likely be confirmed, and we'll see. I mean, I don't want to, you know, he he will be a different type leader than probably like a Werfel, who really was a student of technology change within the federal government, and how to modernize systems and stuff. That was kind of his background. I think Billy Long will be more like a manager, like someone that's the face of the agency, that maybe delegates some of the more technical stuff to other folks, and that could work well. So, I think we'll have to wait and see how it plays out.
That is all for the questions.
Well, it's 56 after, so we did not go over, but we didn't. It was a good discussion. Yeah, I think Michelle, the timing of this was really good because we're in the middle of all of this. But of course, we also have a lot of unanswered questions. Don't take any of these provisions we just talked about to the bank, and start advising clients on them, because they're not law yet. They're going to change. Like, some of them will definitely change. A lot of them will, maybe change. And we'll have to see what the Senate comes out with and what makes it in the final bill. And how quickly we get legislation.
Well, I ask everyone to stay tuned to your e-alert every Friday, because Thad will be giving you a full and complete update as we slog through this.
With that, I would like to thank Michelle and Thad for the update today. I'd also like to thank all of our participants and attendees for being here with us as well. We thank you for your interest in NAEA's updates. Our next one will be September 30th. So put that in your calendar, same time, 4 p.m. Eastern. And with that, we all hope you have a wonderful day. Thank you.